We continue to see more and more calls that a recession may be coming. This chart on the Bloomberg showing how the two tens have steepened significantly since their inversion. But Goldman Sachs now calling a recession at about 35% over the next 2 years. What metrics are you watching?
Well, certainly the Federal Reserve, the trajectory of rate increases. We think they have the leeway to move fairly aggressively early in the cycle. But as we get into late 2022 and into 2023, we think the Fed will be more measured. If they're not, certainly they're walking a finer line between economic growth and an outright slowdown. One of the wild cards out there is the economy's greater interest sensitivity after years of ultra low interest rates and adjusting to that.
What does that mean in terms of portfolio allocation? Because, of course, valuations have been pressured with yields rising as well.
Yes, our feeling is that we should be reducing our risk ratio, our risk tolerance in this kind of environment, but really within asset classes rather than moving wholesale into more conservative sectors of the market. Specifically in the stock market, for example, we would focus more on technology because of the longer term opportunities there, and on healthcare, a growth area less economically sensitive over the next 12 to 18 months. Interest rates moving in toward shorter dated maturities, but not a major reallocation across asset classes themselves.
And Gary, you talk about the rates moves and how that's going to impact your allocations and your positioning. Take a look at this chart. The market is pricing in 8 more hikes in December. Chances when we get to 2024 is that we'll get a cut, and those chances or those sort of that pricing is starting to rise as well. So you talk about tech. Typically, we see big tech kind of, growth type names not doing very well in this environment, particularly when you take a look at the moves in the bond market. Is that typical, though, given that we've seen some kind of counterintuitive moves in pricing for tech as well?
Well, I think higher interest rates do create something of a headwind for technology. Our view is that looking through the cycle, there are still great opportunities in technology. High quality, the other adjunct is that we're focused on higher quality, large cap, liquid stocks, strong balance sheets. And in the tech area, that means that the longer term opportunities can be married with that. So we're maintaining our favorable rating there as well. As far as the trajectory of interest rates is concerned, a lot is going to depend on what happens with the economy, with inflation, COVID, the impact on supply chains, the war in Ukraine. And that will, I think, shape the trajectory of Fed moves late this year and as we move through 2023.
What's more important for you as an investor, the pace of heightening? We just heard from the RBNZ Governor Adrian Orr really saying for him it's about the pace of combating inflation rather than the end point. Or is the end point the ultimate rate that we arrive at more important?
Difficult to say. I think both are quite important. As Fed President Bullard mentioned, we did have very rapid increases in interest rates in 1994, one of the most aggressive periods of rate hikes, and the economy managed a soft landing. I think it's different. The environment is different now. I think there is a risk in the Fed moving too rapidly for too long. Up front in the cycle, I think they can afford to be a bit more aggressive. But again, as they move toward late 2022 and through 2023, they're going to have to be eyeing the economic environment, inflation, far more closely than I think they will have to up front.